Good evening, everybody. I'm Sue Herrera filling in tonight for Susie Garib.
And I'm Tyler Matheson. Welcome. We begin tonight with some good news. Stocks closed near their highs for the day. Now, the not so good news. The major averages all lost money today, but not much, just a little. Chalk it up to unsettling economic data from China, where exports fell sharply, and to worries about rising tensions in Ukraine. The Dow was down triple digits at one point today, but it rallied late. At the end of the day, the industrials closed 34 points lower, pressured by Boeing. The Nasdaq was down by 1 and the S&P down just a fraction from Friday's record-setting close.
With the Dow solidly above 16,000 and the Nasdaq sitting at near a 14-year high, it may be hard to believe the recent bear market bottom was exactly 5 years ago. But a lot has changed since then. It's a bull market now, and a lot of retail investors have come back into stocks. A bit more cautious and perhaps a bit more skeptical than they were before. Jane Wells has more.
But as Countrywide does what it has to stay afloat, some people have floated the B word around.
It was the worst of times.
I'm concerned about what's happening with all these banks,
which never seemed to get any better.
Banking regulators jumped in Friday to take over the mortgage lender after withdrawals by panicked depositors.
Banks folded, homes went under, jobs were lost, investments took a hit. And 5 years after the market bottomed, people still remember their fear.
You know, we were pretty close to a collapse of the financial system.
The whole thing is that nobody knew where the bottom was.
Fidelity surveyed investors who said 5 years ago 65% of them were scared or confused. Nearly half lost significant assets. The average drop in portfolio value was 34%, and nearly 1 in 5 saw a head of household lose a job, cutting that person out of the bull market which followed.
The fear takes over, and it got me as good as the next guy.
Lamar Jones runs his own business in North Carolina and thought he was investing wisely in dividend-paying bank stocks, which ended up worth almost nothing.
I thought I could buy an Aston Martin car, and with the money I lost, I probably could have bought an Aston Martin.
5 years later, he's back in the market cautiously, and he's not alone. Fidelity says now 56% of investors feel confident and better prepared. TD Ameritrade says investors are more sophisticated, and options now comprise 40% of daily trading volumes, up from 12% 5 years ago.
However, TD Ameritrade also tells us that people who are long the market are, quote, constantly nervous with one foot out the door, while those shorting stocks, quote, really like their positions. Perhaps both remember the not too distant past and hope they are better positioned to act if history repeats itself. For Nightly Business Report, Jane Wells, Los Angeles.
Let's turn to Jeff Kleintop now for his analysis of what's going on in the markets. He's Chief Market Strategist at LPL Financial. Jeff, welcome. And we're going to have plenty of time to talk about the markets, but I'd like to get your reaction to Jane Wells' report just then and talk a little bit about the sensibility of individual investors today. Are they smarter? Are they more judicious? Are they too careful? What do you see and feel?
Well, Tyler, they've been a bit too careful. What we know over the last 5 years is most individual investors, whether they were unable or unwilling, sat out most of this bull market. It's really only in the last 4 or 5 months that we've started to see individual investors come back to U.S. equity mutual funds. That's based on data from ICI. And that may be only because the 5-year rolling return has just started to turn really sharply positive. We know they chase returns and they're feeling better, but maybe only because those numbers have soared into the double digits.
And Jeff, that's what has some people worried, is that the individual investor has sat out from much of this market run and maybe getting in just as the bull starts to fatigue a little bit. But you're still longer term bullish on the market, correct?
Yeah, I think we've got some maybe a good year ahead. We had a great year last year. I do think we've got some gains ahead. While certainly as individual investors come back to the market, that can often be thought of as a sign of a peak. We've got a little bit of M&A activity coming back and maybe some IPOs too. But it usually takes a few years of that, at least a year and a half or so of that, for excesses to begin to build up. But instead, what we're seeing is good earnings growth coming back this year, better economic growth here and abroad. All of that should support modestly higher stock markets this year.
Are there particular sectors of the market or kinds of mutual funds that you would suggest at these prices and based on the forecast that you have for the future?
You know, Tyler, much of the gains that we've seen have been built on the consumer coming back, but it's really businesses that have held back but now may be beginning to be the new drivers of the economy and earnings. So look to those business spending-oriented sectors like technology and like industrials, one that didn't do so well today, as being the leaders in the market here and perhaps through the end of the bull market.
We've had a lot of volatility in the emerging markets, Jeff, as you well know. Would you allocate cash there? Things have calmed down a little bit, the situation in the Ukraine notwithstanding. Or would you stay away from there? Are the opportunities better domestically?
A long-term investor may find some value in the emerging markets. There is strong growth there, and valuations are relatively attractive. But in the near term, and probably over the course of this year, U.S. stocks still look a bit more attractive. Most emerging market countries still need to go through some adjustments here to a world where there's a bit less money being pumped into them from the world's central banks. That's something they're going to have to get used to. Take a bit of time, and some volatility will come along with it.
Tell me where you stand on the question of managed, actively managed mutual funds versus taking basically an index approach, either through mutual funds or through the ETFs?
Well, both can make a lot of sense in a portfolio. What we've seen is that passive investing has certainly been a big winner in recent years, particularly last year, a very tough year for active managers. But as the pace of growth begins to moderate in the markets, and we're now at the mature stage of the business cycle where there are bigger differences between sectors and stocks. Take a look at this year, a much broader range of performance among sectors. That's an environment where active managers can begin to outperform. Volatility tends to be a real plus. I'll just give you a quick stat. When the VIX is 2 points above its 3-year moving average, meaning volatility is a bit above normal, active managers tend to outperform the benchmarks. We may be entering an environment where volatility is a little bit higher, and that could be a win to the back of those active fund managers.
Very quickly, Jeff, if you need to add yield to your portfolio, if you need some income, how would you do it?
You know, high-yield bonds are a great place to go for that. Watch out, however, for areas like REITs or utilities in the stock market. They can be very vulnerable to higher interest rates we expect to see over the remainder of this year.
Jeff, interesting point there on the VIX and how it can help active managers. Jeff Kleintop, thank you very much, Chief Market Strategist at LPL Financial.